39.90 and 39.10. There's a bit going on there.
Do you trade them?
Oh, I do occasionally.
Yeah,
I do occasionally.
Are you viewing this as a bear market rally, looking to get short for new lows?
I'm viewing it as I said. I'm viewing it. Everything that happens right now until the FOMC, or unless GDP changes the whole thing, right? But until FOMC, everything what's happening now is technically we are seeing breaks which are very tradable. But I just still see it as a reset, too many dollar bills at the same time, hitting serious levels as well. And now we are seeing the reset market, and rightfully so, trying to find a bit of pausing, or pivot is a big word, but I'm viewing it as a reset. And then once we get the FOMC, then we'll pick up the direction that's needed.
Okay, let's bring Ryan in. So Ryan's sticking with Aussie.
Yeah, sticking with it. It's run right into trouble where I expected 65.20 to 40. Bit of a zone up there. It has moved under 63.50 if you want to look at a shorter term chart, like a 15-minute or something. Next support is down, small here in the low 30s, then it's really 64.10. If we hold there, keeps this bullish move in play, but we need a move through 65.40 to lift it further.
Okay. Euro, I mean, it's the opposite of the dollar. Is this just an ABC and we're going to top out here and flush again? This low came off a confirmed low, which tells me that there could be another one. And, that's making me, think that maybe there is one more hurrah on the dollar. And, just the way it looks to me. Your first sign will be closing back under parity, which, were these highs. But, right now it's above the moving averages. It's just a feeling. I don't have any great technical reason to do it here.
Yeah. I think above 99 keeps it in play.
99, okay.
Yeah.
Because here's where these a couple moving averages, 98, 83. Okay.
Good stop level, just below there, isn't it?
Yeah. I don't like the way the metals are kind of dragging their butt compared to the weakness we had in the dollar. That there still could be, we're still under that level you pointed out. That's been a pivot, Ryan. It looks like it could just flush one more time. So one more down. Okay, so here I am. WD Gann. It might be early. I'm not doing anything yet, but I'm willing to, just say, okay, I caught the wave in this decline in the dollar and up in the S&Ps. I actually feel more confident about staying long S&Ps as long as they're above 3,800 at the most, 37. These highs right here. But, I keep hearing Joseph Wang, who I think is pretty good. And he was constructive on risk. Here's your tagline for the Wang interview, Stel. Joseph Wang, constructive on risk, long risk, short euro.
Thank you.
So, okay, so he was actually looking for, risk on and the dollar rallying at the same time, which, I stuck in my brain. And it's happened before. So, a strong dollar, hasn't always hurt the market. I mean, look, up until recently. Any thoughts, Stel, on what you're seeing here?
Well, remember we've been talking about the run up to the Fed, and we said that we're probably going to see a little bit of risk on, a little bit of dollar weakness. Did talk about 3,900 on the S&P.
You did.
We said 3,941, 41 was a bit.
You have an evil twin?
On the
who is we?
Here on this webinar, I mean.
Okay.
So we mentioned 3,900.
I'm a Gemini, Stel. I could at least say it, you know.
So I said no. 3,941.41. I did say last time. I think it's going to be a little bit difficult to get, but 3,900 is very doable. And but again, over the Fed, it's I would be very scared to be long risk or short the dollar just for this meeting. I think from the next one onwards, probably we might be getting a change from the Fed. But at the moment, I don't see what's going to throw them off course. We did get the Bank of Canada yesterday, which hiked less than expected.
Maybe that's what I saw. Yeah, BOC instead of BOE.
BOC, yeah. So they hiked 50 instead of 75, and that's it's a small thing at the moment, but it is a thing. That's what I was saying on the flow show. It's first you get the Bank of England with the help in the bond markets, and now you get Bank of Canada doing less, and it's like many little things starting to accumulate. So I think we're going to get to the pivot sooner rather than later, as Steve would say. But the pause, yes. But I don't think it's going to be this meeting. I don't think we're going to get something new this meeting. So we'll need to get another little flush lower in risk, and then, as I've said before, due to the way inflation is calculated, we should see inflation come down in early 2023, all else being unchanged. So and I was saying on the flow show. Danny Blanchflower on the Trader Summit debate, he said something really interesting. He said that the central bankers look at what they think the economy is going to be like in 1 or 2 years' time, and they try to anticipate how it's going to evolve. So theoretically, they want to stop the hikes or the cuts, depending on where we are in the economic cycle. They want to stop the action a year before everything manifests to the economy. But that, unfortunately, with their credibility being shot at the moment, they can't really stop now and say, yes, we think in a year's time or a year and a half it's going to be all great, because everyone's going to laugh at them. So they're going to end up probably over-delivering in terms of rate hikes. That's a risk they're running now. We are seeing PMIs turning lower. We're seeing all the leading indicators kind of not doing well. Lagging one is inflation is still high,
sticky,
but it is sticky. Yeah. So the Fed is in a tight corner at the moment, and I don't think they're ready yet to make the pivot, the pause, whatever you want to call it. So I'd be very careful over this next week's meeting. But in the medium term, I think. I think the euro dollar is going higher. I think the dollar index is going lower. I think when that pivot comes, and inevitably risk assets are going to go higher. I think that's and the difference between now and 20, 30 years ago, when we used to get a recession and equities used to drop, is that back then it wasn't the case that we got a recession and they just plowed money into the market, QE, and take rates to zero. This has been an extraordinary measure that's supposed to be supposed to last for a year or two, and it was going for 15 years or however long it was, and even though central banks know that theoretically this is not the right way to treat a recession. Obviously, if there's a crisis, like 2008, yes, you can bring out the big guns for a little while. But now it's almost certain that when recession comes, when inflation starts dropping fast, they're going to cut rates and they're going to do the same stuff over and over again. And I think that's what the market's trying to second guess.
Looks like just in case you guys forgot, it's not half past the ECB. It's in just under a minute now.
Oh, is it 15? Really?
Yeah, quarter past.
Was it not supposed to be? Well, they changed it. Okay. Yeah, so 40 seconds to go. So we're expecting 0.75%, both the main refi rate and the deposit rate. And obviously, we want to see what they say in terms of the asset purchase program and how things are going to evolve, and if they give us any new information. So let's see, 15 seconds remaining. We get some data as well, important data out of the US in 15 minutes, GDP. and others, but let's have a look at the ECB first.
It's a real carnival today.
It is. It should be a busy day, and with
Let's
Blake
get
being
on the
out,
Ferris wheel.
You know what's going to happen with Blake being out. It's going to be all hell breaking loose. Okay, here we go.
Blimey.
I don't see it.
Yep, 75.
75. Okay, so as expected. So, yeah, I mean that price action shows you it was all baked in.
Yeah.
No real surprise. I mean, 3 pips either way.
Yeah,
nothing. Yeah.
Let's look at the details. What's Euro doing?
Well, here we go. Now they're absorbing it. But yeah, it kind of reminded me of Geraldo Rivera's big opening of Al Capone's locker. You guys remember that? There was really nothing in there. Yeah. Oh, well, you're in Europe. Yeah. Anyway, he was a reporter, and it was a big deal. Like, he found Al Capone's locker. He was going to open it live on air.
Oh, what? And was it empty, really?
Yeah. Yeah, there was nothing interesting in there.
Anticlimax.
Yeah.
The ECB stuff, it's a bit same old, same old. They're going to continue to raise rates until inflation is, falling back to target, blah, 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 blah. Doesn't look to be any differences, i.e. they're going to slow, they're going to speed up, anything like that. Just on a quick flash over the headlines. Well, go into it a bit depth at the moment.
Okay, interesting.
Little pressure in S&Ps. Yeah, we have red candles, today. Because the dollar's popping. I mean, that's all there is to it. Dollar's good. Yeah. That's why I found what Fed guy said so interesting, because there's really been hardly any differentiation lately. For a risk to be okay with a dollar rally to new highs is hard for me to imagine. But that's his call. So anyway, I don't have a lot of conviction to do much new here. Still holding long silver miners. I haven't done anything in the the gold or silver market. I wish we would just get this break over with here, because I do think that this is going to be a great setup long term. I've seen all kinds of things about the volume accumulation models and everything on the gold miners and stuff. And, Newmont doesn't look bad, and it was really a pig for a while. It's trying to come out of here. So it's one heck of a base. So, even if gold goes to, breaks, to 1580, 1590, Newmont may not make a new low.
Yeah, it could be. The risk you're running is a short-term risk. That's the thing, I think, with miners. But it could be substantial. If we do break below those lows in gold, and we get which means that we're going to be getting a stronger dollar, which means that we're going to get equities dropping. That's a double whammy. So gold goes down, equities go down, so gold miners go down or more.
Yeah.
So, but again, I think that's going to be probably a short-term move. It will depend on the Fed. You are unfortunately a passenger on this trade, depending on the driver, which is the Fed, at least in the short term. So
yeah. Well, I'll tell you what, GDX over here sure looks like a head and shoulders formation to me.
It does, yeah. So I'll tell you what, if the Fed is not hawkish next week, these are going to absolutely fly. But unfortunately, I don't think that's the most probable scenario for the Fed.
It isn't.
That's a problem I have.
Yeah. Okay.
Also, I don't know if you saw earlier on the chat room, I posted an image of APMEX, APMEX. I don't know how you say it. The online metals retailer. We're saying we will buy your silver eagles at $10 above spot. Now tell me what's wrong with this picture. Spot is spot, but really physical is on another planet. And this it's weird because this is with silver, not with gold. Gold obviously has a premium as well compared to spot, the physical, but it's nowhere near percentage-wise what that is. I mean, $10 on silver is 50%.
Yeah.
So that's interesting.
I mean, I've paid 10. The 10 is a good deal, 10% over.
Well, that's 10%, not $10. I'm talking about $10.
No, 10, yeah, 10%.
10%, yeah. 10% would be, I mean, that sounds stupid to say, but it would be acceptable.
I know. I mean, the spread used to be maybe, 0.5%.
Yeah.
And they were happy on that spread. So, yeah, I mean, that story's been out there for a while.
Yep. This, how do you say it? This, the difference between spot and where physical is trading has become bigger and bigger. Flow show. The futures, they're linked to a deliverable. You buy a futures contract, you carry it to maturity. You expect the seller to deliver to you the physical that's that underlines a contract. So what happens when the price is so much higher? You buy it at 19.3 or whatever, and then you expect delivery, and you know that you can sell it for $10 above. Not a bad trade.
Yeah.
Anyway, I don't know how that works. This has been the case for a while, though. So we could say it and laugh, but it's been the case for a while. So what happens? When does this break? I don't know.
Yeah, I don't know when they're going to finally get the squeeze going on the paper market. Something else I just wanted, I don't want to. Bitcoin came out of the hole pretty good.
Indeed.
And Ethereum. So, all the bears weren't right. I'll leave it there. But I wanted to show this. Okay. So this was the invasion. Okay. And, this is the Fed tightening. So this was the fear that so far never materialized, right? Because, I mean, they were able to get some grain out. Can you imagine what the fear would be if there's a dirty bomb that goes off in Ukraine? I really think, when you think about it, like say wheat's $8, all right, and it's a 5,000 bushel contract. I think that every charity and community should go out and lock in some wheat prices, and that's like 40 grand, right? To take the cost of your contract, full cost of your contract, and have that be your food hedge. I wouldn't know what to do with it. Put it in a silo, turn it into bread. But I think this is a great Russia-Ukraine hedge right here. So we had the initial break, and now we're correcting it. If anything does go wrong there on a nuclear level, we could be, well above these highs, because you wouldn't be able to farm that land ever again.
Yeah, let's hope that doesn't happen, because
it's good. Yeah, I pray for peace, but I'm just saying it's a very, it makes me feel worse than Bobby Axelrod, who made a lot of money shorting airlines during 9/11, and he's a fictional character in Billions, but that's how he made his money. He was sitting in his office, saw the first plane go into a tower, and started shorting airlines. So I know Ryan would do trades like that.
No.
Wouldn't you?
No. Well,
no? How about Iceman? He's, I think Iceman's a little sappy like you and me, Stel. Are you?
What about me? Sorry, I was concentrating.
Oh, if you,
Caveman.
If you were sitting at your desk and you were in Manhattan and you saw a plane going into one of the towers, would you short airline stocks?
I would just run.
I'll tell you. I tell you what, guys.
I would just run.
I've seen you, man. You can't run.
I tell you what, guys. When 9/11 happened, I was in Canary Wharf in London, and we had the towers basically right next to us. So I was at Barclays at the time, and when it happened, we were all shocked. And then we looked around and we're like, yes, there are two big buildings here. Maybe we should evacuate it. And everybody just evacuated straight away. Within an hour, we're all out. Yeah.
Wow.
It was scary. Scary.
Yeah.
Anyway.
All right. So I hope I've cheered everyone up. Give me a Y if I've brightened your day with my.
Yeah, thanks, Dale. Another cheering Dale episode.
Oh, my Armageddon trade. You guys like that?
On Coach's couch.
Yeah.
So let me ask you a question, Dale.
What
happens if GDP, which is expected to come in plus 2.4%, what happens if it comes in negative again? That'll be the third quarter on the trot of negative GDP. Does that cement the recession?
I think that we've already cemented the recession, and what I'm thinking about is, can Jerome Powell pull off a Captain Sully and land a 747 on the Hudson River?
Nope.
Okay, so that's the main thing I'm thinking of. Huh?
I don't.
That's what he's trying. That's what he's trying to do. Okay.
Yeah.
As far as I'm concerned, to pull a Captain Sully.
Yeah.
Anyway, reassessing the dollar. I'm not ready to turn and buy it, but looks like I could start drinking milkshakes again. Going to new highs.
Oh, we're hitting parity again now on the euro.
Yeah.
Actually, Ryan, what you were looking at option expiries? Where the the big lumps?
This is 99.80. Oh, that was support.
Give me 1 second. I shall get it up.
I'm just curious because usually when is a day when. Well, actually, no. Today is a big day. We could get something from Lagarde on the presser, but
yeah, we got usually... We've got 2.32 billion at parity. The next big one's 98.50, 2.11 billion. Okay. Up above, we've got at 10020, 629 million, 10040, 733 million.
Okay, so we're going to gravitate probably towards parity, unless something. We are at parity, unless something big comes out of the.
You called it.
Yeah. Plus,
I think we're going to get this gold thing over with. I think into the Fed.
Let's see.
Yeah. Go ahead.
I was going to say, Dale, you have Mark Chandler today, don't you?
Yeah, Mark's going to be making sense. SENSE.
He's one of my absolute favorites. Seriously, the guy, not only his knowledge but the way he communicates. I really, really like him.
He's loved by many.
Basically, the opposite to Kman,
Huh?
I'm kidding.
Loved by only his children.
Okay, so what else can we talk about for the last couple of minutes? You mentioned cryptos. They are, they are bouncing, and Ethereum specifically is doing really well. Hit 1500, which somebody in the chat room was talking about 1500 when we were down at 13 or so. So that's been a pretty big move, but we're still close to that breakdown level in Bitcoin. I know we're a couple of thousand away, and the percentage-wise, it's 10%, isn't it? So, but
first.
Yeah, could do that. That would be I don't know.
Okay.
I'm not sure, but the Fed's going to drive that as well.
That's my call. The next one's yours. 800-899 bear. That was what I used to say on my radio shows.
Oh, really?
Yeah, those are my calls. The next one's yours. I tell you, man, wasn't I a carnival barker? Yeah.
I see Mark. I'm going to promote him.
Mark is here. Oh,
yeah, good. I just promoted him.
Because I've been nonsense today. We need some sense today.
All right.
Okay. Anything, guys, you want to wrap it with? Last thoughts came in.
We're expecting GDP in 1 minute, but I'm underwhelmed by ECB decisions so far. So
So is the market.
75 baked in, APP, no change. But they seem to twinkle or change telephone teltros a little bit, but it's not really of the likes of changing too much to it. So for the time being, a bit underwhelmed. So
yeah,
I'd be a rally seller perhaps on euro crosses, depending on what comes out on the US GDP. If US GDP,
well, we could wait for this GDP, and then we'll put Mark on.
Yeah, we have 15 seconds, so let's wait for these numbers. We have also core durable goods and durable goods, jobless claims, but really GDP is the big one. All right, any second now. Expected 2.4. Oh, durable goods is weaker.
Goods 0.4%.
2.6. Okay, so that's better than expected.
Yeah.
Continuing claims 1.
So here come higher yields. See if we're good. Well, we were here earlier, 405. No, well, yeah. 406.
Unexpected 2.4.
And the euro dollar is not doing anything.
S&P held 3,800 again. So I don't know. That's a pretty good line in the sand, guys, right here.
It is.
For your S&P longs, if you are long. And remember, it's a mattress, not a piece of concrete. So it's not an exact number, all right? Where, you know, it touches it. And oh my God. None of that. Oh, no, oh my God. It's the rest of the week, everyone.
Jobless claims a bit weak as well. 4-week average up to 219K versus 212K prior. So jobs a little bit softer there, feeding in. Obviously, NFP comes next week after the Fed. But yeah, that GDP is probably going to undo a bit of all that negativity we saw this week from the other data.
Yeah, metals coming back too. Anyway, use your 15-minute chart. There's plenty of trades if that's what you want to do. I have a hard time like thinking about something I could hold for a few weeks right here. I'm going to ask Mark. Maybe I'll get some clarity. Thank you, team.
Thank you, Dale.
Yeah, good job. Good job. Fun, also fun. We have a little fun this morning. A couple of laughs together. You know, we got to laugh, right?
Yep.
It's fun to laugh. It's almost as much fun as drinking a milkshake. Anyway, I'll see you, my trading warrior brothers.
See you, mate.
See ya.
All right. Thanks, Stel. Mark, welcome back to F.A.C.E. How are you?
Good morning. How's everybody?
Everyone's okay. Looking forward to you making sense today.
I
was making nonsense. So why don't we start with the news of what the ECB did and what you think has been happening here in the euro?
Yeah, sure. I mean, right, the ECB did what everybody expected it to do, but I think that what we're missing so far, and we have to see what Lagarde says, is that the way that the Federal Reserve expanded its balance sheet is that it bought a lot of stuff. We know that. It bought mostly bonds. The way the ECB expanded its balance sheet was also through long-term loans. Long-term loans, 3-year loans that are incredibly attractive, sometimes negative yields, negative rates. And so they decided to tweak that. And what's going to happen, that is to say that they're going to raise the interest rate on that sort of retroactively. And what this is going to do is going to encourage banks to pay back those loans. In turn, that's going to shrink the ECB's balance sheet. So even though they raised rates 75 basis points like everybody expected, I think that the net takeaway is that monetary policy may be on the margins a little bit tighter coming out of the European Central Bank meeting than people had expected. I recognize, the euro had a good bounce. It pulled back almost a cent or so from its highs to dip below parity. I think that the rally had really left the MACDs, the slow stochastics, sort of stretched. And I had the euro closing above its upper Bollinger Band yesterday. So I was looking for a pullback into this ECB meeting. And as the markets, as you guys, I think, suggested, the market's focus shifts now after we get past Lagarde's press conference towards the FOMC meeting next week and those jobs data at the end of the week.
Okay. Just a little bit more of a telescopic view, Mark, do you believe that this low right here can sustain the euro, or are people trying to top pick the dollar, bottom pick euro, setting themselves up for disappointment and we wash out one more time?
Yeah, so I mean, when I look at all the currencies, not just the euro, I feel most confident that sterling has bottomed at that 103.50 or so we saw at the end of September. And so I do think that when I sort of think about how the dollar extremes are formed, I don't see it as they all peak at the same day or the same week necessarily. I sort of see it like more of a waterfalls, where first one peaks and then another peaks and sort of so on. And so I feel most confident that sterling peaked. And part of it's not just the charts, though the chart looks compelling to me, but it's also about the psychology. When things look bad at the end of September, all this talk about the UK being a third world economy. I see the economists calling it brittly. I see a lot of banks, but people who experienced people forecasting 90 cents or something like that for sterling. And I just think that this was part of the psychology that is associated with a market extreme. And so I like the fact that even though the euro dipped below parity today, sort of what its breakout was, sterling is holding well above that 115 level where it broke out of. I think that we could see 120 either later this year or early next year in sterling.
Okay. Do you think we see 120 before we try and, this low, the way I described last Friday, Mark, the world changed. I think that it was not coincidental that the BOJ was in for the third time and the Fed leaked that article to the Wall Street Journal. And they didn't have to spend a cent and don't have to call it intervention. But in my view, it was an intervention.
Yeah,
Don't you think the world changed Friday?
I don't know. I mean, I know everybody, this is the sort of the common folklore in the market, right? That the Federal Reserve leaks things to a reporter.
I'm full of folklore, man.
Yeah. And, everything the reporter writes is not a leak from the Fed. And I think that even without reading that Wall Street Journal story, it was clear that other Fed officials last week, including on Friday, Daly, and the day before that, I think Bullard, also playing down or at least not endorsing what the market had been leaning towards, which was a 75 basis point hike, not only in November, but December. I don't know if that, for me, I think that it was a part of a larger thing that was happening. And like I say, I thought the dollar was already topping out before last Friday. So I don't know. I mean, what do we really know? We know that the Federal Reserve, or what we think we know, is the Federal Reserve will raise rates 75 basis points next week. The market has moved back towards about 50 basis points in December. Further rate hikes next year, in the first part of next year. So the terminal rate really hasn't changed much. It's still 4.75 to 5%. What strikes me is that despite all this Fed pushing back, the market is still pricing in a very good chance of a Fed cut at the end of next year. And rather than look at 3-month Eurodollar deposits, which, if you take delivery on that, you get a 3-month time deposit. So a lot of things can happen in that 3 months. That's why I use the Fed funds futures. And I'm looking at the difference between the December 2023 contract and the September 2023 contract.
Want to share your screen, Mark, and show it?
I'm sorry, I don't have that available right now. But I can tell you that spread is about 22 basis points. That is that the yield on the December contract at the end of next year is pricing an almost 25 basis point cut by the Fed, meaning that the market expects the Fed to have broken something. 3 things can break. Inflation can break down, and I think you guys were talking about that before. I'm fully aboard with that, thinking that here's how I see it. 10% annualized CPI in Q1 this year. 10% annualized CPI in Q2 this year. In Q3, we fell to 2%. And so I think that is a prelude. I think that when we look at the year-over-year rate, there's too much of an echo. It's like looking at a 200-day moving average when you want to trade for the next week. It's not very helpful because the history has too much of a weighting. And so when you really look at the recent trends in inflation, it's broken. And so I think that coupled with the slowing of the economy allows the Federal Reserve to take its foot off the brake and cut rates towards the end of next year. But besides the inflation, what else could break? financial stability. This is what happened before when the Fed stopped doing its QT because the system needed greater reserves. And the third thing, so besides inflation and the financial stability, the third thing is jobs. And next Friday we get the U.S. employment report. Job growth is slowing. And I mean, you can see this, 3-month averages lower than 6-month averages, that kind of thing. But we're looking at something like around 200,000, which is still a relatively good number for the U.S. I looked back at 2018 and 2019, and in those 2 years before COVID, the U.S. averaged 150,000 jobs a month. So a 200,000 print next month or next week is still a pretty strong number.
Right. Okay. And you're okay with the Fed really looking at a lagging indicator like that?
Well,
or whether or not they're successful.
Yeah, I don't know. I mean, it's like, what else do you have to use? I mean, and so of course, I think this is what you guys were talking about before. That of course the Fed's trying to shoot at a moving target. It knows it has a lag in policy, and it knows its data comes with a lag as well. And so I think that to me, it's not so much a difference whether the 25 basis points here or there, but it's the main thrust of policy. And I think that the cost of bringing inflation, say, from 4% to 2% is going to be much more costly to the economy than bringing it from 8% to 4%. And the 2% inflation target, we take it for granted now, but everybody, I shouldn't say everybody, all the different countries measure inflation a little bit differently. They all target something around 2%, but 2% in Japan is not the same thing as 2% in the US. And if anything, we talk about the Japanese, but if the US had their inflation, we would be done raising interest rates. And yet many people are encouraging the Japanese to raise interest rates despite that inflation numbers. So I don't know what to make of it. I just think the Fed tries their best. They're a flawed institution. We are flawed as far as the economic data and what we have to use, but it's only what we got. So I think that's sort of like when you have a hammer, as Abraham Maslow suggested, all the problems look like nails.
Oh, good one. Okay. So, kind of give me a little macro here on what you think the movement is going to be. Do you think that we're still going to continue to turn up in the euro? Mark,
Yeah,
I know it's been lagging the pound, and I agree that the pound is, but I don't think we're going to see these lows. Could we see 108 again? Yeah, we could see 108 again. I don't think we could see this again, but if the pound starts to pull back, and I see these targets up here, and from saying these levels to say, what right here, say 61.8 back or so, that would take the euro to new lows, right? So if it peeled off,
yeah, it could. Like I have, it's sort of like Thomas Edison. He says that he didn't fail; he found 10,000 ways it didn't work. And I think that's what happens to guys like ourselves in the market, Dale. We have scar tissue, and handling winners is one thing, but it's really not about being right more often. I think that's a game that we play early. I think that's a young person's game. I think an experienced person's game is managing the losses, risk management. I see this often from traders when I look at the track records. Make a little money, lose a lot of money. Make a little money, lose a lot of money. And so it seems to me, in my experience, as much as what I've seen, suggests that limiting those losses is maybe even more important than being right more often. And so I think the same thing with the Fed. What we're trying to do, I think, ultimately is manage risk. And that's how we in currency markets or traders differ from gamblers. I think gamblers are less able to manage the risk. You bet on lucky 7 because it's in the 7th post position, or you bet on a certain sports team. It's hard after you have your wager on to really manage the position. But that's what we really talk about in the markets, right? Is managing that risk.
Okay. And I don't know about you, but I do trade with biases while I'm managing risk. Like, if I had a bias here, would I buy a pullback? First of all, the leader is cable, so that's my preferred long. But in euro, would I try to buy a pullback here at, say, 99, 98, 80? I might try it if I thought there was going to be a continuation move. of the dollar. And, are they going to make this 110 breakdown look insignificant? That's kind of what's going on here today. So
Yeah,
if it's a big breakdown, how come we're, not following through is what I'm asking myself.
Yeah, so that's what I sort of saw too with the euro yesterday closing above its Bollinger Band. I also have the biases, of course, partly what to expect. And this balance, I think this is the other thing that makes us different than gamblers, is the balance. When those people discovered the DNA, they sort of had a rough idea what they were looking for. But it's that tension between knowing what you're looking for and sort of projecting, and so I think the same thing here. When I look at long-term charts, I often find that the dollar index, like the euro, like the Deutschmark before it, often makes like a double top or a double bottom at the extreme. To me, when I look at this dollar index chart you have up, it's close to a double top pattern for me. So my bias is the kind of top I'm looking for is a double kind of top where you make a high, it pulls back, people buy it again because that's what they've been doing for the past year or so. It doesn't make a new high, or it makes a marginal new high, as the case may be. Here we made a lower high. And so this is
more
to me,
bearish.
Yes, I think this is just, it's not that it always works. That's why I think I talked about Blake last time when I was on, the idea that what we do is we maybe lose a knuckle. We lose a fingernail trying to pick these. We look for these opportunities. We don't lose a hand. We don't lose an arm. We take a small wager. This looks like what could be an important top. And it could be wrong, but it's playing the odds. And so you have the wherewithal to do it a few times. But this, it's sort of like you go to a roulette table and there's 9 reds in a row. So I know the next, it's still 50-50 shot, but I more likely bet on green then. And I have the wherewithal to bet on green a few times. And so I think the same kind of thing here, where you see a pattern, it might hold, it might not. It's not 100%. We live in a probabilistic world. And so I'd make a shot for it here. But I agree with you that if you're trying to look for the faster horse, the horse that you have the most confidence in, that's why I say I feel most confident that sterling has bottomed. The euro may have bottomed. The Aussie may have bottomed. Dollar Canada came close to 140. That might be a top for the US dollar. I feel most confident on sterling.
Okay. All right. And as far as only risking a knuckle or something like that, Adam and Eve must have been a trader, Mark, because when God came to him and said, I'll make you a woman, but it's going to cost you an arm and a leg. Adam said, what could you do for a rib? So he was only willing to give up the rib. Anyway.
Very good, Dale. I won't quit the day job for that stand-up comedy routine.
It was a little better prior to the interview. Anyway, okay, so now I finally got it. It took me 17 minutes to get it out of you by putting up the dollar index chart that you think the dollar is peaked, and you're confident about cable, and maybe euro did, but this is bearish to you until proven otherwise. And you probably, if you're really a generalist, you probably have to stay with this until it, at least takes out the prior failing rally high, right? 1360 or so.
Yeah, what I would do is, for me, I would try to use even a tighter stop. I would take a retracement of that high. What do you have it? 5 days ago or so.
Yeah, 13 right here.
Yeah, and look for that to look for the retracement of this last leg down.
Okay, so maybe around 11.5 or 12. This was
something like that. I sort of like the 12 level, but I know the curse is round numbers.
Yeah. Okay. And then you could risk that high. Okay.
I think so.
All right. Nice tactical share. Anything you want to wrap it with, Mark?
No, I think we've gone through like so many crises recently. You think about like the getting out. First it was like getting out of the great financial crisis and the unwinding of the QE and stuff. We had we had COVID, the Russian invasion, this adjustment. Back at the end of 2020, we had something like 17 or 18 trillion dollars of negative yielding bonds in the world. It's a mind-boggling thing. And so the markets had to make this big adjustment to a positive interest rate environment, this reevaluating, reassessing asset prices in light of positive interest rates. Another shock. The Federal Reserve, the aggressiveness, another shock. But in my work and try to look ahead to the future, I think we're through that. The bulk of those things. We got to get through this winter, of course. But I think that this now is sort of like that snake that's eating a dough. It takes a while for the body to digest it, but I think we're doing a fairly good job in the markets of digesting this. Even though volatility is high, I think that next year, lower volatility, lower inflation, central banks pause in their cycle. I think it'll be a better year for all of us.
Wow. Okay. So hope is the oxygen in our life and the carbon monoxide in our trading.
Very good. Good luck to everybody.
Yeah, hope. So there's hope, guys. I mean, let's say for I don't know how many times have we lived through stuff like this, Mark, and there was always a light at the end of the tunnel.
And that's what I'm suggesting, really, is there's light at the end of the tunnel now. We've done most of the heavy lifting for the central banks. Yes, the war in Ukraine continues, and that could always worsen. We got a winter ahead of us, and for the northern hemisphere, we got to get through these things. But as far as these policy shocks, this adjustment, I think we're well through the process.
You know, Mark, you and I have been doing this for a while. It is the most fascinating that it's ever been for me in this time period that we're in. I've never seen the word unprecedented used. It's unprecedented how frequently it's used. You know what I mean, Mark? Yeah, this hasn't happened in 100 years. This hasn't happened in 15 years. The bond decline, it hasn't happened since the 1700s. All these things that are occurring that on a magnitude are, quite a different ball game than it has been for a long time.
And that's the history. As much as I like to think of myself as a student of history, it's not a perfect guide. It just lets us know the range of possibilities, which are of course so large.
Yeah. So it was great talking to you.
Thanks. Good luck.
Appreciate it. Good luck to you, Mark, and follow Mark on Twitter at Mark Making Sense. And I don't have your website up. Website address, please, Mark.
Well, you guys post my commentary, but I have my own blog called Mark to Market. Mark with a C. Makes my mother happy.
Okay, and look for Mark on Twitter. Whenever I see a tweet, bro, it helps me, and whenever I talk to you, it helps everyone else that's listening. I much appreciation, my trading warrior brother.
Thank you. Good luck.
All right, that's a wrap, everyone. Mark Chandler, Making Sense, and that we've done the heavy lifting, and we can look forward to 2023. A little different than my wheat trade, and keep an open mind, and you'll keep your account open. I believe the team will be ready for the morning edge in a little less than 25 minutes. Don't just count your pips, count your blessings. Good luck, everybody. Good hunting, and adios. See you tomorrow for TGIF.